spot versus perpetual futures. In this section, we're going to explore an essential concept for anyone who wants to trade crypto, the difference between spot trading and perpetual futures trading. We'll also uncover why something called the funding rate exists and how it affects traders who use futures markets. You'll see charts and examples on the screen that help you visualize how these two types of trading work. By the end of this session, you'll clearly understand what you actually own when you buy on the spot market, what happens when you trade perpetual contracts, and how professional traders use the funding rate to their advantage. What is spot trading? Let's start with spot trading. Spot trading simply means buying or selling the actual cryptocurrency at its current market price. When you trade on the spot market, you truly own the asset. You can hold it in your wallet, transfer it to someone else, or sell it anytime you want. Your profit or loss depends entirely on the price movement of that coin. If the price goes up, you earn. If it goes down, you lose. For example, if you buy one Bitcoin at $60,000 and later sell it at $62,000, you've made a $2,000 profit. It's straightforward, transparent, and perfect for investors who prefer to own the real thing rather than speculate on price. What are perpetual futures? Now, let's talk about perpetual futures, a completely different approach to trading. A perpetual futures contract is a type of derivative, which means you don't actually own the cryptocurrency itself. Instead, you hold a position that tracks its price. With perpetual futures, you can take two directions. You can go long, which means you expect the price to rise, or you can go short, which means you expect the price to fall. Futures trading also allows you to use leverage. For example, with 10 times leverage, you can control a $10,000 position using just $1,000 of your own capital. And unlike traditional futures, perpetual futures never expire. That's why they're called perpetual. You can keep your position open as long as you want. Let's take a closer look at this comparison table. It clearly shows the main differences between spot trading and perpetual futures trading. Starting with asset ownership in spot trading, you actually own the cryptocurrency. When you buy Bitcoin on the spot market, it's yours. You can hold it in your wallet, transfer it, or sell it anytime. In contrast, with perpetual futures, you don't own the actual coin. Instead, you're trading a price contract. It's a financial agreement that follows the price of the crypto without you ever holding the real asset. Next, let's look at expiry. Spot trades have no expiry. You can hold your crypto for as long as you want. But perpetual futures also have no fixed expiry date, meaning your position continues indefinitely as long as you maintain the required margin. That's why they're called perpetual. Then we have direction. In spot trading, you can only profit when prices go up, you buy low and sell high. That's why we call it buy only or long. But in perpetual futures, you can trade in both directions. You can go long if you expect the price to rise, or short if you think the price will fall. That flexibility is one of the key attractions of futures trading. Now, on to leverage. Spot trading usually involves no leverage. You can only trade what you actually have. But in perpetual futures, you can use leverage sometimes up to 100 times your capital. That means with just $100, you could control a position worth $10,000. It amplifies profits, but it also increases your losses just as fast. Finally, we have risk level. Spot trading carries lower risk because you're holding real assets and there's no leverage involved. Perpetual futures, on the other hand, are considered higher risk. The use of leverage and fast-moving prices can cause your position to be liquidated if the market moves against you. So, in summary, spot trading is safer and simpler, great for beginners and long-term investors. Perpetual futures are more advanced. They offer higher potential returns, but also much higher risk. Knowing these differences helps you decide which one fits your trading style and risk tolerance. Now let's dive into something a bit more technical but very important, the funding rate. Funding rate exists to keep perpetual futures prices close to the spot market price. Remember, since perpetual contracts don't expire, traders could all pile onto one side, everyone going long or everyone going short. That would push the futures price away from the real market value. To prevent this imbalance, exchanges introduce the funding rate, a small payment exchange between traders every few hours, usually every 8 hours. Here's how it works. When the funding rate is positive, long traders pay short traders. When the funding rate is negative, short traders pay long traders. This system encourages balance. If too many people are long, it becomes costly to stay long, so the market naturally evens out. You might see two countdown examples on the slide, one from MEXC and one from Bitunix, showing a timer that resets every 8 hours, reminding traders when the next funding cycle happens. Let's break this down with an example. Imagine you're trading XRP, one of the popular altcoins. If the funding rate is 0.01% every 8 hours, here's what happens. If you're holding a long position worth 10,000 USDT with 10 times leverage, you only need 1,000 USDT as margin. But every 8 hours, you'll pay $1 to the short side. That's 10,000 times 0.01%. Now, if you're on the short side, you'll receive that $1 instead. It may seem small, but across multiple trades and large volumes, this adds up, and that's exactly how funding rate arbitrage opportunities appear. We will cover more about funding rate in next chapter. So why does all this matter for traders like you? Because the funding rate creates a way to earn without predicting price direction. Some traders build strategies that combine spot and perpetual positions, one long, one short, and profit from the funding payments rather than price movement. Understanding how spot and perpetual markets work is the foundation for funding rate arbitrage, one of the most interesting and lower risk strategies in the crypto world. You'll learn the step-by-step setup for this in the next chapter. All right, let's test your understanding before we wrap up this lesson. Question 1. When you buy crypto on the spot market, what do you actually own? You can pause this video to think about it. You own the real cryptocurrency itself. It's stored in your wallet, and you can hold, transfer, or sell it anytime. Question 2. What makes a perpetual futures contract different from other futures? You can pause this video to think about it. A perpetual contract has no expiry date. It runs continuously, allowing you to hold a position for as long as you want. Question 3. When the funding rate is negative, who pays whom? You can pause this video to think about it. When the rate is negative, short traders pay long traders. That means the people betting on the price going down are paying those betting on it going up. And finally, what happens if you close your position just before the funding time or open it right before the next funding cycle? You can pause this video to think about it. If you close before the funding time, you avoid paying or receiving the funding fee. If you open right before the cycle, you'll be included in the next funding payment, so timing can make a difference to your profit or loss. Take a moment to think through your answers. These questions may seem simple, but they reflect the mindset of smart, strategic traders, people who don't just trade, but truly understand how the market mechanics work. Closing summary. Let's quickly summarize what we've learned in this section. Spot trading is where you buy and own the real cryptocurrency. Your profit comes from the price rising. Perpetual futures let you trade price direction using leverage, and you can profit even when prices fall. The funding rate keeps perpetual prices stable and balanced between longs and shorts. By understanding both spot and perpetual markets, you've just built the foundation for more advanced trading strategies, including funding rate arbitrage, which we'll explore in detail very soon after we cover some fundamental trading concept.